Hi, everyone. It's Anthony Caporrino here again. Today, we're going to talk about A&M's commercial diligence practice. And in today's private equity market, many firms are faced with countless challenges, ranging from high levels of dry powder, intense competition for deals, and an evolving market. And in this type of market, commercial diligence oftentimes is the first step towards unlocking value creation. So today I'm here with A&M's U.S. leaders for commercial diligence, Jen Holland and Liz Pearsons. Jen, Liz, welcome.
Thank you.
Before we get into our conversation, maybe each of you can give a quick background on yourselves, and then we'll get into our discussion.
Sure. Thanks so much, Anthony. So, Jen Holland, I have been in and around commercial due diligence for private equity firms for the past 15 years, spanning two different firms. So I started my career at the Parthenon Group, which was quickly acquired by EY and is now EY Parthenon. And then I joined Bain in 2018, and I was a partner in their private equity practice, doing largely commercial due diligence, pre-acquisition, and then also post-acquisition growth strategy work for our clients. Very happy to be here.
Hi, I'm Liz. I have a very similar background to Jen in that I've spent the last 15 years also in commercial due diligence, all of that with Bain & Company. So started off as a generalist and then sort of morphed over time to specialize in consumer retail and across some software sectors. So Jen and I are longtime industry depth experts in this business.
Great. Welcome to you both. For everyone out there, we're going to be talking about what's changing in the market today, how commercial diligence serves as a value creation lever, and what all of you out there as investors need to know. So first question to you both, what's the trend today, in your opinions, that people should pay attention to as it relates to commercial due diligence?
I think that it's hard not to talk about AI in the relationship with commercial due diligence and frankly, any professional services business today. But oftentimes the trend that you see people saying and associating with all of these different professional services firms is the belief that AI is going to make it faster and cheaper. It certainly will make some things faster and cheaper. But I believe that the narrative is not capturing the full nuance of the impact that we're likely to see. If we assume that commercial due diligence is only going to get faster and cheaper, that is also assuming that commercial due diligence is already the perfect product and already solving all of our clients' needs. And the reality is the product is fully constrained by resources, data availability, and time. And that has been one of the biggest things that's formed and put together the commercial due diligence product that we see today and have seen. Instead, I think that AI is going to impact our professional services world in very, very different ways. You're going to see potentially a bifurcation of impact. One will be very early in deal generation, up the funnel, where you're looking at things in a way that you can look deeper at it and faster at it than you ever have before. Say no to more faster, lean into the good stuff faster. But then when you get into the late stage deal process where you're nearing a close, the demand for conviction around value creation and exactly what you're going to do post-close the bar is going to be a lot higher. And therefore, you're going to need the tools to be able to deliver that, but you're also going to need the senior expertise. So I don't know, Liz, what else would you add?
No, I think that's right. AI is the obvious one that impacts our business. I think we can do things in an hour that used to take us multiple days. I think our clients are experiencing the impact in a couple of different ways. I think there are sort of three main things. One is in how they make investments. So thinking about the risk and opportunities created by AI and companies that they're looking at and in their own portfolios. Two is how they run their own businesses, which is, leveraging AI in their own internal processes and thinking about how to use it the best way. And then three is in how they interact with service providers like us and how they interact with commercial due diligence. And I think what we aspire to be on the same level as our clients as we think about how to use AI to accelerate insights, outcomes, results, and sort of make everything better together. This is not, Claude didn't exist when I started doing this business 15 years ago. I was, picking up the phone and cold calling truck rental businesses, which we will still do. So to Jen's point, there's a lot that can't actually be disintermediated by Claude. But I do think that there's an obvious sort of accelerant in this business that Jen and I see and our clients are experiencing. And it's an important signal for us to work on how to partner better with our clients to leverage the value that AI can bring while still bringing the critical lens of human judgment to the investment process.
Okay, so I heard a couple words that stood out. Number one, disruption. I think you've articulated, both of you, and that's today's market. And then two, Liz, you mentioned acceleration. So when I think of those two words, that's like a perfect environment for how A&M functions, right? We've
Yes,
been disruptors
100%.
over many years. So with that as a backdrop and knowing that that's a market that favors our strengths, what attracted you to come to A&M to lead the U.S. commercial diligence practice?
Those things attracted us. But Anthony, you said it so well. And as we mentioned before, we spent 15 years in and around this industry and this sector, and we are seeing this moment in time where not only the needs of our private equity clients are changing, but also the environment in which they are working with technology and disruption is changing. And so as a result, we knew we needed to be in a place that was going to support some of that change and be fertile ground for that. And it's really two things. One is structurally how A&M organizes itself, which is incredibly unique, and it fosters innovation, it fosters change, and it fosters the ability to be very close to our clients and understand what our clients need, because we put ourselves as senior leaders closest to the clients, and then we have autonomy and agency to build what they need. And two, the other major reason is that A&M already has all of the full due diligence suite. And really, CDD was the last missing piece of that. And so now we can truly be one-stop shop, not one-stop shop in the sense of it's one invoice, but one-stop shop in the way that it's fully integrated, it's the way it's meant to be. Business due diligence across all of the different service lines, not just commercial versus ODD versus FDD, et cetera.
Yeah, I think that the things that ultimately attracted Jen and me here were the ability to be really flexible in what we offer our clients and the way we structure our teams and the way we serve the work. We see an opportunity for true partnership because we can be more nimble. We are building from scratch here. We're sort of zero basing the team structure. We're zero basing the SKU structure, what we're able to deliver, what we're able to answer. And that said, I don't like to talk about AI with also talking about how important the human judgment layer is. Yeah. We are still fundamentally, at the end of the day, humans helping other humans invest other humans' money in management teams who are humans. And so I think the operator expertise that A&M has and the heritage that A&M has of being inside businesses in a way that other consulting firms have not, 30% of the 13,000 employees having either currently in interim management roles, having lived inside of businesses or former operators. I think that combination is something that's truly unique to the business that we're building here.
You've talked about AI and the changing landscape and maybe getting more information faster than maybe you would have before AI came into play for CDD. And then you mentioned the human element, human judgment. Yeah. So when you sit here today and you look at what a good commercial diligence practitioner can provide and what those characteristics are, in your opinion, in today's market, what makes a really good commercial diligence expert?
I mean, a lot of it comes down to fundamentals that have always been true about what makes a good product. Some of the things that you're mentioning, which are, AI enablement, the human-led judgment. I mean, these are inputs to the product. What makes a good product is, as long time been true. It just hasn't always been something that, we've been able to achieve. And I think that if you put the right human judgment and the right tools, we're going to get a lot closer to what we know good has always looked like. And for us, we've been orienting our entire build and our team around three things that we think good looks like. And in the backdrop of it, of course, is the flexibility that Liz mentioned, but it's really these three things, which is one, it's the willingness to take a perspective, a true point of view on something. I think too often we hedge because of time constraints and data constraints, and you don't have perfect information, so you have to hedge. But with all of these, additional inputs and ways of thinking about this, we should be able to take a position because, frankly, our clients have to take a position. They have to take a bet. And so we're helping them understand what bet they're taking, a probability attached to it, for example. The second is what I already mentioned, but it's really important, is that it's integrated, it works with the other parts of it. So too often, because of time constraints, we're working in silos, which is not the full picture. And we need to instead be integrated because at the end of the day, our clients' questions do not vary by service line. The question is whether or not they should invest in this deal and what is the outcome of it going to likely look like. That doesn't change whether or not they're having a tax conversation or quality of earnings or commercial due diligence. Now, the component parts may, the pieces to that answer may, but the core question doesn't. And so it should be integrated. And the third is, and this is an important litmus test for us, is whether or not it is useful post-close. Too often we think our 300-page decks are going in the trash, and they aren't necessarily useful post-close either because they're theoretical in nature and just not operationally yet enough. We should be putting together value creation roadmaps very early on that the operators can use post-close, and we have to be leveraging our operator heritage to be able to get there. But so for me, it's really those three things. Liz, I know you feel strongly on these too.
That's exactly right. And Jen is always so articulate. I think the utility of the CDD product is something that Jen and I have focused a lot on. I think over time, as the private equity backdrop and the industry has matured, and as service providers serving private equity have matured, the market work offering has become more commoditized and not as targeted and helpful. And our aspiration is to partner closely enough with our clients that we can really get to bedrock on how to make this useful for them once they've done the deal. And I think, there was a long time where capital was plentiful, assets were plentiful. You were really trying to steer your clients away from doing bad deals because there were so many deals out there to do and so few competitors out there competing for those deals that it was easier to kill a deal and walk away from something. But our clients now are sitting on unprecedented levels of dry powder, as you mentioned, Anthony. And I think the challenge that Jen and I have tasked ourselves with is how do we help our clients lean into good deals and make them great? And that's just a slightly different framing than the way we've spent our last 15 years of doing commercial diligence. And I think the integration and the operator expertise that A&M brings to this picture will allow us to make commercial due diligence useful in a way that it hasn't historically been, and that we're going to be able to help people make decisions, as Jen said, about how to do good deals versus how to walk away from bad ones.
Yeah, that makes a ton of sense. And I think you both have done a good job articulating how a traditional commercial diligence has evolved over time, but even in today's market, and even more specifically, how it will evolve here at A&M. So having said that, at what point in the evolution does commercial diligence begin to influence value creation, and how does a client take your findings and weave that into a value creation plan? In your experiences, how and when does that happen?
I mean, it doesn't happen soon enough in our experience, and it needs to happen a lot sooner. And I think this is what we're hearing. I mean, Liz and I have been speaking to so many different private equity firms over the past 6 months, and almost unanimously, we are hearing this need for value creation and a little bit of hindsight being 2020 around. I wish we had focused on value creation sooner. I wish we had built it into our underwriting case. If we don't put it into the underwriting case, our team doesn't necessarily hold the management team to it. We don't have clarity around exactly what we need to change right away without it. So frankly, I think the value creation plan should be built from day one, right? When you're looking at the asset for the first time, it should no longer be a conversation just about whether or not it's a good asset that you want to own. Still an important question. You still need to have the fact base. Still need to know if the market has some fundamental tailwinds or not and what could disrupt it. But you also need to know what in year one, in the first 3 months, are you doing to create value in that business as a strategic owner of that business. And we're seeing some firms have been doing that for a long time, and other firms are waking up to the fact that they need to be doing that actively, especially as they're sitting on some assets that they'd love to be liquidating at this point or love to be exiting.
To me, this is where the value of the integrated offering really
Yes.
comes to life, because if you're able to institute that early enough in the process, you're all fundamentally working off of the same Q of E data
Yeah.
book and using the same numbers. The revenue forecast and the pricing opportunity, the customer opportunity, everything that's related to the growth, the top line growth of the business can then be integrated through with the operational work to understand where do we actually think margin's going to land? What's the fan of outcomes on this business? And so to be integrating early, which is a unique benefit that we can bring, I think is a critical piece of the equation. And that's where I see, going back to the last question, the utility of this market work or commercial piece really accelerating under the A&M umbrella in ways that it doesn't and can't elsewhere.
So as you think about value creation in today's market that's very volatile, for lack of a better term,
Yes.
what are some things you would say make an asset look like a high quality asset?
I mean, it's a number of things. So first you have some of the things that, we would have always looked at, whether or not it is in a strong market that has, strong tailwinds associated with it, durable growth. We're not at certain penetration peaks, and really understanding where we are in those peaks and valleys across penetration that so often are missed. The quality of the asset in terms of the durability of the revenue streams and the repeat, revenue that they have with their customer base, right? All of these things that our clients have always looked at, which is like, durable, non-cyclical, reoccurring, revenue streams, all continue to be important elements. But we also have the element of understanding how certain factors will potentially disrupt those streams going forward, because we've experienced so many what we'll call black swan events in quick succession. It's hard to almost call them black swan events because we've had these on the outskirts, low probability events continue to happen that have disrupted. And so we believe it's very important to be understanding exactly what bet you're taking. And what that means is understanding the underlying drivers of a certain business and industry. This could be, for example, you might be looking at a HVAC business that has regional concentration. The bet you believe you might be making is around HVAC tailwinds and the growth of a roll-up strategy and these synergies of that. But in reality, with this regional concentration, you're actually making a bet on the discretionary income of those residents in that region that happen to be linked to X manufacturing industry. And this is just a hypothetical example, but getting back to that root cause, how much of a bet are you making on China resources and supply chain? But this is what, if we unpack an asset further enough, we will be able to really get at what is the bet you're making. And therefore, when you have disruption that may hit the market, how will it impact you? These different flavors of it, disruption. Because what we'll ultimately do is, and what we view our jobs as doing, is helping our clients understand the bet they're making. Because at the end of the day, they are taking a bet. They do need to probably take some of these bets. They just want to be making sure that they're leaning into low probabilities. As a part of our build out, we brought on a chief macroeconomist who's helping us to think through some of this, peeling back the onion, think through some of the micro dynamics across the US. And we're incredibly excited about the work that she's doing because it's helping us unpack things like, maybe we might rely on CPI for pricing and why that's flawed. Maybe how we might have thought about cyclicality analysis in the past and why that's flawed, but instead it has to be viewed at a micro level. So much will go into it, but it really is understanding kind of what is the foundational element. And then the second part is how do you actually create value? So is this company set up to create value and execute on the growth forecast, which is a completely different question than whether or not it exists in a fundamentally good setting.
Yeah,
so it's complex.
so that's what gave me pause about your question. I kind of had to think for a second because it was like what defines a high quality asset is a little bit of a circular reference with what's the thesis. Because you need to really understand what it is that you are underwriting. Is it, is it customer durability and the fact that you're going to keep net retention as high as possible? Is it the acquisition target runway and the ability to roll those acquisitions in synergistically? Is it the ability to generate cash flow that grows with inflation, but then make meaningful margin improvements because you're getting manufacturing and procurement savings? Like there are a number of different ways to define a high quality asset. It just depends on what you're hunting for. And I think what Jen and I are, what we aspire to do here within the walls of A&M is be able to narrow down in a very clear and synergistic way with our clients. What is it that you're hunting for? Let us go and help you figure out if that thing is there or not. Because I think there are, high quality can mean a number of different things depending on what the thesis is.
Interesting.
And I also, Anthony, if I can add too, because Liz, you're making me think, right? That's like the power of the back and forth. Because it's such a good question. It's such a fun one, right? It's what we have to spend all of our time thinking about. But the other aspect is you can't get away from valuation and price when you think about whether or not it's a high quality asset or not. So often we're looking at the core essence of it and if it's a high quality asset. But there's a natural cyclicality that we see across private equity investing in around what's popular right now versus unpopular. And there's this just classic phenomena, and we see it across the board. We're seeing it in consumer right now. We're seeing people run away from software right now. We're seeing people run towards blue collar, stuff that infrastructure that they can touch and feel. And there's this effect, it's the classic irony where the prices get inflated and they keep getting in. Everybody's saying that's a sure bet. That's a great place for money. Well, it probably is at a certain price point. And the thing that you just left because it got overinflated now is price correcting and might actually now be the thing you want to look back at again. And so you see this cyclical nature. And I think that asking yourself, are we just chasing the next theme that everyone else is chasing, or are we taking a bit of a contrarian view and acting on our own a bit? And those that can do that and do that well, we see oftentimes are the trendsetters, are the ones that can hit it. And so it's more than just what makes high quality asset. It's also where do you sit in certain investment cycles and popularity.
Interesting. So one of the things as I hear you both answer that question, I'm thinking about. I interviewed a number of folks on this podcast, one of which was a professor from University of Chicago who had done a lot of research in what makes a great CEO. A
Mm.
doer, a
Love that.
salesperson, something in between. And then we've talked a lot over the last few minutes about value creation. Value creation is contingent upon a management team executing it. So where you sit in your CDD offering, how much, if at all, do you touch upon or get a feel for management's capability to execute on that value creation plan, knowing what you know or what you discover about a company and where they fit into that overall plan and the prospects for growth?
It's a good question. So we, just by nature of our work, we are comparing a target company to its competitive set and comparing our target company to its analogs or any analogs that exist, in relevant industries. And so we're able to get a viewpoint from that sense in, has this team kept up with the competition on the critical factors that differentiate them? Have they done what they say they're going to do? Have they integrated these assets and actually allowed them or enabled them to drive above market growth? But I do, there's a bit of an intangible factor. This is where I go back to AI is not going to completely disintermediate this, right? Because eventually we're humans helping humans invest other humans' money in other humans. And so I think the one thing that actually it's a bit of a commercial, but our A&M now has an in-house executive search firm that does management due diligence, which I think is an amazing unlock to pair with CDD, because it's not just understanding what this management team has achieved relative to the competition. It's doing deep diligence on the individual executive team members as C-suite executives. What has their track record been? What do the people who work for them and with them say about them? How do we feel about their ability to achieve growth? And if we don't feel good, what would we suggest about how to reshuffle the team? I think we are truly able to partner with our clients on all aspects of the deal in ways that Jen and I haven't really seen before. And I think we'll be able to touch on exactly that question, Anthony, with a different light than we were able to at our prior firms.
Yeah, Liz, I'm so glad you brought that up, because what's interesting is management assessments, at least in my experience, have traditionally been a little bit off limits within commercial due diligence. Beyond attending the management meeting, having management interviews, and then relaying our thoughts, on how they acted and kind of reacted to questions and how we perceive them to be, which is that's a very, very small amount of interaction that we actually have had to them. But we are able to kind of compare and contrast relative to the hundreds of management meetings we've been to. But other than that, it never went into any sort of formal document. It was always just side conversation. And it really was not a part of the scope, given this sensitivity attached to it. And yet, how often have we heard that private equities say the biggest mistake we made was not making management changes faster, right? Because if you want anything really to have strong change, putting in new management and letting them have 2-3 years to actually have effect is critical. And in a 5-year hold, you got to do that really, really fast if you need it. And so we would comment on, well, the growth plan is not what we saw, the historical team do. But we wouldn't necessarily do a deep sense of exactly what's the pulse in the market, what's the feedback on this specific management team, what was the backstory going into it. Those elements should not be separate from the overall business due diligence. And I think I'm so glad to have that capability now and do it in a real way.
Well, and it's just like the financial due diligence shouldn't be separate, right? The operational diligence shouldn't be separate. The HR and benefits diligence shouldn't be separate. The IT diligence, the product diligence, the cyber, the AI, like all of these things, tax, everything sort of belongs together. And I think there's as you lay out the thesis, going back to, we're trying to understand what the thesis is and whether those points hold true. As you lay out the thesis, each of those questions needs to be answered with a bunch of different inputs. It's not just market. And historically, we have said, okay, here's the thesis for the commercial work. Here's the thesis for the tax work. Here's the thesis for the ops work. But by actually integrating all of those things together and teaming across the different service lines at A&M and the different offerings that are really, really good, we can sort of bring a much more holistic picture to each of those answers, and get a greater confidence level on the fan of outcomes.
Yeah, as I listen to and as we talk about how CDD has evolved, and if it really is a lever in the value creation plan, it almost has to include some viewpoint on
Yes.
management and all the other things you've listed. And I would think anyone that asks for commercial diligence just to assess the size of the market is probably not doing themselves the right level of justice in order to really get the maximum benefit out of it.
That's right. It's one of my favorite things when people assume commercial due diligence is just sizing the market.
All right. Well, that covers a lot of the detailed areas. Now I'm gonna just fire away on a couple questions for each of you to wrap it up here. So one, what's a word, if you had off the top of your head, to describe today's deal market?
Oh,
I like Jen's. Go ahead.
you've heard me say this before. I'm going to say it again. Sorting is what I would say.
Okay. What
And
sector?
do you know what I mean by that, Anthony?
Yeah, say
No,
more. I like when she describes it.
Why
So,
don't you describe it? Go ahead.
so you see a lot of movement across whether or not you see deal professionals rolling out of funds and creating their own funds. It's the funds that are not having trouble fundraising, the ones that are having trouble fundraising. We are seeing a sorting between the funds that are really able to create value creation and above market returns, and the ones that maybe benefited from a very frothy period of time where we had declining interest rates and a flood of capital into the market. And so it's exciting. And, let the winners win.
Okay.
Yeah, my word is similar to Jen's. I think about it as evolving. I think we are at this stage, and I referenced the maturity of the industry. I think we are starting to see just a different leg of a different imperative on how our clients and our own business, how we all need to operate in an environment that is now effectively a mature market. And the competition has changed. The way that we as service providers need to partner with our clients is changing. AI has introduced this whole other layer of change into the whole equation. And so I think we are in a period of time where, and Jen and I are so thrilled to be doing this with A&M in this moment, because I think there's a massive evolution going on, both in how our clients are having to participate in deals, and also how professional services firms who support private equity in doing deals have to engage.
Okay. A sector you're both watching closely today.
So you can accuse me of being biased 100% because my background is in consumer products and retail, but I am watching consumer closely. I think we've seen huge shakeups with many funds turning their backs on consumer. And right when you see this many funds turning their backs on an asset is exactly when you start to see the price correction and the opportunities emerge. So I'm very much watching it. And I know it will be an asset class that will perform for funds again.
I mean, software. There has been a dramatic change, obviously, in the last 24 months, but even just here in 2026. And I think, I'm eager to see how things play out, because the buy side market for software, I think, has come to a screeching halt. But there are a lot of software companies sitting in portfolios that are going to have to get sold. So what happens to those? What's the strategy? How do we think about operational improvements for those businesses? I think there's a lot, a lot to do and a lot to think about. And for folks who say sort of software PE investing is dead, I really firmly believe that is far from the case. And I think there's a lot to do, and I'm curious to see how it plays out.
One thing PE firms need more of today.
Well, I think that, and this actually plays off of software, it's patience with the good assets. There's a lot of good assets in software out there that may not be the right time to exit on them, patience with them, but probably even more importantly, discipline with the bad ones, and starting to, create room in your portfolio for new assets, letting go of the ones that haven't performed or were overvalued, because, ultimately we need to see the movement and the return to LPs to keep these funds afloat.
For me, it's day -1 value creation. I think if you're entering a diligence process on an asset without having a clear view or thesis points to test on how you will make money with this business when you sell it, you're doing yourself a disservice. And so starting from not just the check the box exercise on diligence, does this pass, all of my hurdles? It's really, how do I think about, before I even start seriously looking at this business, what I will do to it, what unique value my fund can bring to making this business a better business and guaranteeing myself a successful exit. I think that needs to be a lens.
Okay. One thing the market is getting wrong today.
I referenced this in the beginning, but I think it's the narrative around AI. And that it's going to impact this market in many, many, many ways, but it just being faster and cheaper is oversimplifying the magnitude of impact.
Yeah, I mean, I don't want to be cheesy, but just same answer. I think
It's a good answer.
We hear some funds, actually, the number of clients that Jen and I have spoken to recently who have told us, when Claude came out, we thought that it could replace all of our commercial due diligence, and boy, were we wrong. I think the expectation on what AI can deliver in terms of diligencing an asset has been, people are getting that wrong. And I think you still need the human judgment layer. You still need the super high quality face-to-face primary research. You still need the impression of the management team. You need to sit across the table, human to human, and figure out, like, what do I really think of this person? Can I team with this person? Will this person execute for me? And Claude can't answer those questions. And frankly, Claude can't apply the judgment of a diligence team who's looked in the space 100, 200, 300, 800 times. And so I think we are hearing a lot of our clients who had been very bullish on the ability for AI to disintermediate the need for third-party diligence really walk that back, which is obviously good for our business, but I think it's better for the answer too.
Yeah. Okay. Last question to you both. Best piece of career advice you've received to date?
Oh my gosh, so I've had so many amazing mentors over the years and so many good pieces of career advice, but I also have 3 daughters. My oldest is now 12, and I think I've learned just as much from being a mom to them in many ways as I have from my mentors. And when my oldest was probably about 3 years old, I was stressed in my, coming up in my career, going a million miles an hour. And I would say to her a lot of times, it is what it is. It is what it is. Like, get through the day. And she comes back to me at one point and says, Mom, it is what it is until it isn't. And that's the way I feel about this moment in time. It is what it is. It is in the past. And right now we're seeing a lot of change. And sometimes you have to embrace that change.
The one that I always come back to is, you're going to suck at everything the first time you do it. And it's just like, look, everything's a learning curve. We're all in a learning process here. You're just if you go in with the mentality that you're going to suck the first time you do it, you might surprise yourself. And also, if you fail, like, failure is such a learning opportunity. And I'm sure, as Jen and I build this business, there will be things that we get wrong, but guess what? We'll fix it. There will be things, that we need to we get wrong with our clients, things we get wrong with our team, things we get, I mean, we're not going to get everything right. But we will fix it and we will learn and we will continuously get better. And I think entering, starting something new with the mentality that it doesn't have to be perfect and it's better to try and take a risk. I mean, that's why both of us are sitting here with you, Anthony, is because we took that risk knowing that, hey, it might suck because we're doing it for the first time, but I don't think it's going to suck. We're going to be great.
Those are very good pieces of advice on both fronts. So Jen, Liz, thank you so much. It was great to talk to you. I'm excited about the new offering and the ability and the opportunity to work with both of you. So thanks for joining today.